Now, in order to conduct the second test, we need to learn a second term, and that term is adverse loss development. Although it sounds relatively complex, we already know what loss reserves are. An adverse loss development is simply a bad development of those reserves. For example, in the previous example where I said that an insurance carrier may reserve only $800,000 for a claim, well, 3 years down the road, that $800,000 reserve may be adjusted to $1 million. If that occurs, that would be an adverse loss development of $200,000. So, by definition, loss development is any adjustment, whether it's an increase or decrease, in reserves that an insurance carrier sets aside to pay for expected ultimate losses. Now, one thing to keep in mind is when you read financial statements or you read press releases about an insurance carrier, when you hear the term reserve strengthening, it is not a positive term. This should be viewed similar to, oops, we estimated incorrectly in our reserves. Now, the test number 2, examine your insurance company's reinsurance attachment points. This is something that you can do relatively easily by either asking the insurance carrier themselves or the agent or broker to put in writing. Now, what is reinsurance? Reinsurance is insurance for insurance companies. Insurance companies actually buy insurance for themselves to make sure that a catastrophic event will not cripple them financially. An attachment point is similar to a deductible on your car insurance. This is when the reinsurance company will start taking a responsibility of reimbursing that company for that loss. It's very important to ask that insurance carrier what is their attachment point, because history tells us that one of the first expenses to be reduced when an insurance carrier is in financial distress is the expense of comprehensive reinsurance. Why? Because it's very expensive. If you're an insurance executive for a medical malpractice insurance carrier and your reserves are developing much worse than you thought, one of the first things you'll do is to cut expenses. And if your biggest expense is reinsurance, you'll buy less reinsurance and your attachment points will go up. The best example that we can look at historically is Mix, which is now insolvent. In 1997, it had retained $750,000 of every claim. Now keep in mind that 98% of all claims are settled for less than $1 million. But in 1999, when they went public, in order to cut expenses apparently, they increased their retention level to $2 million. Subsequently, in 2000, 2001, and 2002, when the insurance carrier posted its first net loss in over a decade, it raised its retention level from $2 million to $10 million. Now, by doing so, it got rid of any meaningful reinsurance and any meaningful risk transfer and exposed the insurance carrier itself to catastrophic losses. This leads us into our next slide, which is how reinsurance can actually show you why bigger isn't always better when it comes to medical malpractice insurance carriers. In fact, the last insurers in the medical malpractice insurance industry to go insolvent, which is the equivalent of bankruptcy but in the medical malpractice and insurance field, were Mix Insurance Company, FICO Insurance Company, and Reliance Insurance Company. All three of these carriers were the top 10 largest writers of medical malpractice insurance in the country. Why? What doctors need to understand is the dollar amount of premiums that an insurance carrier collects every year really means risk, because we don't necessarily pay our claims for years. Keep in mind that premiums are simply the dollars that are coming out today. Now, assets are always large in an insurance company because we're a long-tail line. Remember, we keep our premiums for 4 to 5 years in medical malpractice before we actually pay claims on that claim year. Now, the larger you get, you can actually buy less reinsurance according to the laws in each state. Therefore, smaller insurers are actually required to secure reinsurance at lower attachment points, which means that they're protecting the insurance carrier from catastrophic losses. The third test that you want to do is you want to examine the AM Best rating history of the insurance carrier that you're insured with. Now, who is AM Best? AM Best is the oldest rating bureau in the world. They were founded in 1899, and all they do is examine the financial condition of insurance carriers. So the credibility is very high. They evaluate insurance carriers based upon their financial results, and they publish them and each carrier that needs to be rated must wait 5 years to qualify for an AM Best rating. But history tells us that rating deteriorations are clearly a good signal of financial trouble and a possible insolvency into the future. You can access AM Best by simply going to their website at www.ambest.com. Let's apply this test to Mix Insurance Company. Mix Insurance Company discontinued writing business and was forced to discontinue writing business in the fall of 2002. But if physicians had done their own independent research of the AM Best rating of Mix, they would have not been surprised when they closed their doors on August 31st. As you can see from this slide, they went from an A- to a B- rating in February of 2002. This B- puts them at the bottom 6% of all rated insurance companies. A month later, in March of 2002, AM Best further downgraded him to a C+, placing it at the bottom 2% of all 3,000 insurance companies in which they rate. By May of 2002, Mix executives chose to not publish their rating to the public, which should have been a clear indication to physicians to make sure that they do not stay with Mix Insurance Company. Surprisingly, over 3 months later, in August 31st of 2002, over 45% of the doctors in the state of New Jersey were still insured with Mix Insurance Company. Had they done test number 3, my belief is that they would not have been exposing themselves. Now, the fundamental questions to ask your agent or broker or your insurance carrier is, has the company been rated favorably in the past by AM Best? The second question is, has the insurance carrier been downgraded in the past? And the third question, learning from our case study with Mix, is if they're not rated anymore, the question is why? Now, this concludes our first educational video section, and the next section is entitled Claims Made versus Occurrence Type Policies. Which one is right for you?